Leverage is the concept of using other people's money. In this lesson, I'm going to show you 3 different examples of investing in the same $1 million asset at an 8% cap rate, one with no leverage, one with 50% leverage, and one with 75% leverage, to highlight the impact on the investor's returns. A good way to demonstrate this is to think of the cash that is generated by the property, in this case, the $80,000 of NOI, going into a bucket. With the investor using no leverage, they get to keep all of the cash in the bucket. In this case, they invested $1 million and are getting a cash return of $80,000 each year for an 8% cash-on-cash return. So when we think about leverage, think about it as partnering with the bank, but at a lower cost. In this case, with the 50% leverage, the debt service on a $500,000 loan would be $30,000 per year. That equals a 6% cash return, the lender's loan constant. The lender's portion is only $30,000. The remainder goes to the investor. The investor keeps $50,000 of the $80,000. And since they invested $500,000 of their own cash, that yields a 10% cash-on-cash return. In this last example, at 75% leverage, the lender is putting up $750,000 of the capital in the form of debt, and the investor only puts up $250,000 in cash. At that same rate and terms, once again, that $45,000 divided by the $750 is a 6% cash return to the lender's loan constant. That leaves $35,000 in the form of net cash flow left over for the investor. The investor only puts up, in this case, $250,000 of their own cash. $35,000 divided by $250,000 investment is a 14% cash-on-cash return. The investor is only putting up 1/4 of the amount of capital, and they're making a significantly higher return on that capital. This is called positive leverage. And effectively, positive leverage occurs when the cap rate is greater than the loan constant. Now, the loan constant can change, as you've seen in other lessons, depending on the interest rate and the amortization. But whenever you have a spread between the cap rate and the loan constant, where the cap rate is higher, it's typically optimal to increase leverage in order to increase the investor's cash-on-cash return. The example I just showed you was an instance of what we call positive leverage, where the return to the lender or the loan constant is lower than the cap rate, allowing the investor to capture some of that net cash flow to increase their return. There's also what's called neutral leverage, where the lender's loan constant is the same as the cap rate, therefore not providing any additional benefit to the investor for leveraging other than reducing the amount of capital they need to invest to acquire the asset. And then, of course, we have what's called negative leverage, and that's when the loan constant is higher than the cap rate. In that case, the investor needs to forfeit additional cash flow to service the debt, where the lender is making a higher return. In order to analyze the optimal amount of leverage to use, simply compare the loan constant and the cap rate. If the cap rate is higher than the loan constant, then use more leverage to increase the cash-on-cash return. If the loan constant is higher than the cap rate, then less leverage is better in order to optimize cash-on-cash return.